Our next speaker is Mr. Rishab Kohli, Managing Director, Orient, the Printer's House. His session is going to be Print Economies, Business Transformation through Digital Printing. A finance professional in Europe and US turned entrepreneur, businessman in India, Rishab Kohli is the Managing Director of the TPH Orient Group of companies. He's been at the helm as founding member and director of numerous leading businesses and worked across an array of sectors including print, packaging, consumables, engineering, solar PV modules, energy storage, and solar smart city products. As business owner in an array of different verticals, he has been able to create an environment that fosters technological innovation, disruption, and high levels of growth in multitude of sectors. Today, he leads a group of companies manufacturing indigenous products at global scale, from solar modules to digital inkjet printing machines, and growing at a tremendous rate year on year. We will learn from him how he has managed this and how he's been growing his organizations at a phenomenal rate. Over to Mr. Rishab Kohli, Managing Director, Orient, the Printer's House. Subject, print economies, business transformation through digital printing. Welcome.
Thank you. Oof. Hello. Can everyone hear me? Yes? Great. Thank you everyone for having me. Thank you for the organizers, Mr. Dhote especially, for dragging me here. I'm not usually one to do some of these. The last few I did were in the energy sector. The one thing that I do love about this is when I look out, I sort of see a lot of familiar faces. I see a lot of people that I know personally and that my dad and maybe my granddad even knew, which is, I think it's a very special thing. Just again, for those of you who don't know me, which I'm assuming is some of you and some of you probably do, I am Rishab. I am the current Managing Director of Orient, or the Printer's House. Just a little bit about me before we start. Okay, the clicker works, that's always a good sign. So a little bit about me, a little bit about Orient. If you guys don't know, it was the first company in India to manufacture a printing machine. So this is long before I was born, probably a little bit before some of you guys were born as well. That's my dad, that's my granddad. They look a lot more accomplished than me, but I promise that's just because I don't have gray hair yet. It'll come, it'll come. So we manufacture offset presses at the moment. About 5 years ago, I would say we got into manufacturing inkjet presses in India, trying to sort of get onto the whole Make in India thing, and we obviously got into it with a lot of great partners and developed the technology in India. A little bit about me. I was a finance professional. I worked on Wall Street, and yes, it is as boring as you think it is, but you get to learn a lot as well, which is a great thing. I was working not in trading, but I was consulting businesses, and our job was mostly, here is $100 million, grow my company for me. That was our role. I was doing that mostly in the energy sector, and then about 5 years ago, I came back to India and applied what I learned there over here. How to grow businesses, how to scale businesses, specifically technology-based businesses. And when I came back to India, we got into obviously inkjet presses, flexo presses, offset presses, solar energy, manufacturing modules, inverters, batteries, and then somehow managed to take our business from $5 million in revenue to $200 million in revenue, which is what we're doing at the moment. And we did this without any debt, without any crazy amounts of debt. We did this at an 18% EBITDA, which is an 18% profit margin. And obviously, I had a lot of mentors along the way. The inkjet press that we had was originally envisioned by Mr. Ramani Vishwanathan, who's no more, but obviously brought to life by our current team members and members in the UK, partners in Japan. I have my director who taught me a lot of things, but realistically, a lot of the principles that I learned on Wall Street, on my time working in India, were the reason for this growth. I also believe that similar theories and aspects can be applied to businesses over here. Before I get into my talk, I just want a show of hands to just understand who it is I'm talking to. So if we're okay, if we have a quick show of hands as to how many of you here are printers or converters working in that field. Just raise your hands. Okay, good, majority of you, which means that this presentation will actually make sense, so that's a good thing. How many of you are just allied manufacturers, so manufacturing things that go to printers and converters, or supplying things that go to printers and converters? Just raise your hands. Okay, great. So look, this applies to all of you, but specifically aimed at printers and converters. What I'm going to talk about today is sort of one thing and one thing specifically. You're going to hear a lot about why digital is good, why you guys have, what color gamuts you can achieve, why short runs are good, et cetera, et cetera, et cetera. That is not what I'm going to talk about. I have excellent salespeople and guys that are technically sound. I am too, but they're probably better off talking to you about this. What I'm going to talk to you about is your business. How does digital printing impact your profit and loss statement, right? You have to understand that short runs, the fact that you can print X, Y, Z on a color gamut, the fact that you need less people, et cetera, are what we in the trade define as drivers for growth. And what a lot of business people do is they misplace cause for effect, okay? What you need to start with is the effect. What is your goal? Your goal is to grow X amount a year, and your goal is to earn a certain profit per year, correct? I think there's other goals as well, but your financial goals are profit and revenue growth, right? I think we all agree with that, yes? Okay, so that is your effect, right? The cause can be 100, so I'm not going to talk about the cause because there's going to be 100 people here that will talk to you about the cause. I am going to talk to you about the effect. And what I believe the main reason to get into digital printing is the financial return you get when you hit a magical number, which is a percentage today, in the next 5 years, is a percentage between conventional presses and digital presses. There is a magical number you can hit which will give you the best financial result moving forward. There is a case study that we did, which I'll get into in a bit, but let's just look at digital printing, the why, how, when, and what. How, yes, we all know, short and mid runs, does a great job for that, so that's a good thing. When, between now and 5 years, anyone tells you different. I think in the last presentation they highlighted it great. It's coming, it's already here. So between now and 5 years, you're going to see an explosion in digital printing, which will come one way or another. It's already coming, and hopefully, my sales guys are down there. You guys better take advantage of that, otherwise someone else is getting your jobs. Joking. The what? A specific numerical percentage mixture between conventional and digital machines. So you have conventional machines, which I'm assuming the lot of you have, which is an array of whatever type of presses you guys own. And then you have digital machines, right? What I'm going to show is that there is going to be a mixture between digital and conventional presses, and there's a magical number between that mixture that you guys will need to achieve in order to make maximum financial return, okay? The why, for me, whenever I look at a business, I look at the financial metrics. It's a responsibility I have. Unfortunately, my dad got sick when I was very young, passed away really before I could join the business. So I, per se, did not have much of a choice. I entered this field. I love it. It's what I do. But remember, a lot of you guys will be second, third generation guys. Your kids, you want to give your kids a business that has a financial return to it. Okay, that is our responsibility as businessmen, to give a financial return in a business so that it can grow in the future, right? So before I get into my case study, I'm going to give you a quick sort of 101 on finance and the way I look at it. Everyone here understands revenue, right? Everyone, obviously. Everyone here understands EBITDA. It's earnings before income tax, depreciation, amortization. How many of you have heard the word ROCE before? Can you raise your hands? Yeah, it's usually the case. ROCE was a term I didn't know either, but when I got into it, I think I was advising FedEx for their energy stuff and a company called NextEra, which is like $1 billion energy firm in the US. And that was my first project. And the only thing anyone talked about was ROCE. That term is return on capital invested. So these are the three things I look at when I look at a business. Okay, when I invest in a business, when I buy a business, when I sell a business, these are the three things that I look at. The most important thing is the one at the bottom. 99% of entrepreneurs in India don't know what this is. It never comes up. The fancy IIM graduates from your consultancy teams will not tell you what it is, but every chartered accountant that you guys have will know what it is. Return on capital employed. How many of you guys invest in mutual funds? Everyone? Yep, that's a lot of people. Okay, when you invest in a mutual fund, you get a return back, right? Currently, you invest in the Nifty, you're going to get 13% for your market rate is 12.5%, right? 12.5% is your return that you get on mutual funds. ROCE, the best definition for that is basically the return that you get when you invest in your business. The items that go into that are EBITDA, investment in CapEx, investment in OpEx. It's not just CapEx, it's also OpEx. So remember, if you buy a conventional machine, it's not just the amount you put in for the machine, it's also the amount that goes into the machine, buying the plates, buying the chemicals, buying all of that. And then it's time. This is not a part of a mathematical calculation. This is more so a part of something that is, how do I put this? That is more, it's not numerical rather than qualitative. Time is something that you guys have given, right? The one thing that you don't want in a business is when you spend 30 years in a business and then when you're 60, 70, 80 years old, you look at your life and you say, damn, why have I spent so much time for this little financial reward, right? You can't just take it into time. I know for a fact, right? I've seen enough and I understand that this is an important aspect of it as well. But this is what you need to calculate. You go home, ask all of your CAs, tell them to tell you the ROCE in your business currently, right? If you're using conventional machines, I'm going to tell you, it's probably not going to be as high as you think, okay? Unless you guys have a very good marketing department and they're getting you orders at a really good rate. If so, let me know. Okay, so now that we've understood what ROCE is, so ROCE is your return on investment that you put into a business. Your working capital, it's your time, it's yada, yada, yada. EBITDA and revenue are two other important factors of this. What I am here to talk to you about is a case study. So fortunately for me, we have these market research agencies, and I asked them to drum up something for you guys. So basically, this is a case study of over 150 to 200 real businesses. This includes some businesses that are in India. A lot of the information is available online. If you go on the ROCE website, you can see numbers of a lot of companies. This is a case study of 150 Indian, I would say about 50% Indian businesses, 50% outside of India businesses, or 40% Indian, 60% outside of India. This is their real numbers. So their real financial metrics, and what these guys did is they analyzed each business and the information available to them and the percentage of conventional machines they have versus digital machines they have. So basically, if you have 100 machines, right, it's an easy number, so relax. No one's telling you to buy 100 machines. But if you have 100 machines, let's say if 50 of those were digital and 50 of those were conventional, or 100 of those were digital and 100 of those were conventional, what would the end financial implication be? What does your financial profit and loss statement look like, right? That is what this tells us. And then I'm going to take you through the journey of 5 case studies and 5 percentage points. So, for example, if you're case study 1, if you're 100% conventional, what does your revenue, EBITDA, ROCE, and your alpha over the current Indian Nifty 50 look like? Alpha meaning how much more return are you getting over a mutual fund. Case study 2 is an 80-20 split. So if you're 80% conventional and 20% digital, what does your split look like? Then you have 50-50, 20-80, and 100%. Is everyone with me? Yeah? Cool. Okay, so if you have 100% conventional machines, now remember this is an average of India and outside of India, so it may not apply to some of you. But the idea is you can't zone in. You have to look at the overall market when making a strategic decision rather than zoning in on a specific segment of a specific market. Okay, this covers converters. This also covers some label printers. This covers a large array, commercial to label, etc. Now, for a lot of you, so I'm taking revenue at X because there's no average revenue. So I'm just going to show revenue if it increases or decreases. EBITDA is 7 to 12% on average. Now, I'm not going to ask how many of you this looks similar to, but I'm assuming it's a lot of you. The issue that I have with this slide is this. Your ROCE is at 9.5%. How many of you would invest in a mutual fund with a 9.5% return? I didn't think so, right? Your alpha over the markets is negative 3%. You're getting 12.5% if you put it in a Nifty 50 rather than putting it in your own business, right? If you measure the ROC in any of my companies, it goes up to 450%. That's unrealistic, and it's whatever. But the point being, if you're investing in yourself and you're giving so much time, because remember, time is that one thing that for some reason an entrepreneur just doesn't value. Value your own time, because you only have 24 hours in a day and X number of years to live, right? This is what you get when it's 100% conventional. If you switch to 80% conventional and 20% digital, look how the numbers change. Your revenue goes up by 5%. I'll go into why at the end. Right now, I want you, again, to focus on the effect and not the cause. The causes will be told to you by every single speaker that talks to you this whole event, okay? There's loads of causes, shorter runs, higher price per print, loads of things, okay? Your EBITDA shoots up to 12 to 16%. ROCE goes to 20%. Your alpha over markets go to 7.5%, okay? Just by adding a 20% increase in digital. And this is as of today. I'm not talking about 6 years, 8 years, 12 years from now. I'm talking about as of today, right? Let's look at the third case study, and that's when you go 50-50. Now, a little bit of this is skewed because it includes American markets, because I will sell outside as well. But I would say a lot of it has to do with the Indian market. Your revenue goes up 10 to 12%. Your EBITDA goes up to 15 to 25%. Look at your ROCE. Now, show of hands, how many of you would invest in a mutual fund if it gave you 46% return? Yeah, right? Sign me up. Your alpha over the markets is 33.5%. This is worth your time, right? Remember, this is worth your children's time. This is worth the generation below you and the generation below you. This is worth their time. And this is something they can grow on, right? This is something they can expand on. However, right, digital is not at a very advanced stage yet, right? Now, if you increase it, look what happens. Your revenue goes back down to when it was 100% conventional, because obviously you can take more prints out on a damn conventional press than you can on a digital press, correct? Depending on the situation, of course. But your revenue goes down to X, your EBITDA goes, stays the same, I think. Your ROC goes down from 46 to 32.5, and your alpha over the market goes down to 20%. Now, if we go to 100, where am I here? 2080. Slide is wrong, I apologize. But if you go to 100% digital, right, your revenue reduces, so it's X minus 5 or 10%, EBITDA stays at 15 to 25%. So obviously digital is more profitable. However, your ROCE goes down to 25%, right? Alpha over the markets is about 12.5%, which is okay, but it's not great. Okay, if you're investing in your own business, it's a high risk business. You don't want to be investing in, I mean, you can, it's better than staying conventional, but remember, digital will grow, right? These numbers will change after 3 to 4 years. I don't know. For the next 5 years, I assume this will be somewhat similar. Now, it depends if you're printing, there are cases where you're printing only digital and you have an amazing return, right? It depends, but I am talking about the general population. I am talking about 90% of the scenarios, not the exclusions or the outliers, okay? So, at a glance, right, you guys can just have a look at this. It's very clear that you're converging at a certain point, right? There is a certain magical number that for 90, 80% of the businesses will work to give you the best financial result between digital and conventional, okay? So you guys should just have a look at that. That gives you a brief idea. This is a graph. Had to put a graph in there. What's a good presentation without a graph, right? Sorry. So you have about 40 to 70%. So that is your magical number. I would say for India, currently you're at about 40, 45% should be digital versus conventional, and you'll hit that 40 to 50% ROCE, which means you'll hit that 40 to 50% return. What concerns me is something else, right? Look how low you are when you're here. Look how low you are when you're here. What concerns me is that if in the next 5 years, you're not at 40 to 45% digital, right? You're in a scenario where realistically, you're better off putting your time, your money in a mutual fund. Sell the business, sell the land, put it in a mutual fund. Mathematically, that's what I'm saying. Now, I have an emotional connection to this business. I love it. My granddad did it. My dad did it. I would kill someone before giving it up. So I'm keeping that aside. But there comes a time where you have to say, hey, there is a financial implication and there is an emotional implication. You guys have to manage both of that. You're entrepreneurs, and you have to make sure that your business continues to grow financially as well as in every other aspect, holistically, socially, however. But I'm here to talk to you about the financial aspect of it, okay? So for the next 5 years, target your sort of 40 to 45% digital to conventional ratio. That's what my numbers tell me. That's what my people's numbers tell me. And based on those numbers, I scaled a business up to 200 million in revenue. So I trust the numbers, right? I only trust numbers. I do not have the experience that you guys do. I do not have a lot of things that you guys have. So I'm forced to trust the numbers. I believe that that has a big, big, big impact on how we make our business decisions. And some of you guys probably should be using market research agencies to give you ideas on the markets that you want to tackle and how it affects and gather data. Before making any business decision, gather data, understand what is happening in India, outside of India, the markets you want to tackle, etc. But in conclusion, that's your magic number, okay? 45%, 40 to 70, but of course it's skewed because of the American case. I would say about 40 to 45% is what we came up with, is the number that you want to have in the next 3 to 5 years. Immediately now you'll get the ROC, right? If you don't do it in the next 5 years, right, you won't get that. After 5 years, the number's probably going to be higher. So you'll be that far behind of the race, okay? You don't want to put in so much capital in one go. You want to put in capital slowly, okay? You want to start dhire, 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 slowly, and then you want to expand into it, right? You don't want to put all your eggs in one basket immediately. You want to do it, you want to learn, and technology will rapidly change, right? My ink prices will drop every other year, probably. I'm assuming so. My machine prices and specifications will change after every 3 or 4 years. So will everyone else's, right? You guys need to make sure that you are ahead of the curve. Don't put in, don't wait for 5 years and then put in 10 million into machines altogether. You're just going to mess it up. Expand slowly, expand correctly, and you will win. This is one of the fastest growing businesses in the world. You look at education, you look at labels, you look at packaging, you look at commercial printing. I don't know where anyone has got the idea that it's not growing. I grew my printing business, my machinery business, threefold in the last 5 years. I do almost 4 times as much, 4 times, 5 to 5, 4, 20, 4 times as much as I did in 2020 as I do now. That does not happen in an industry that's not growing. It doesn't make sense. But you got to pick your pockets. You got to pick the right niche. You got to pick the right timing. You got to pick the right investments. And yes, you have to work hard, but that I'm sure everyone does. So make sure you pick the right times, pick the right pockets. But the way I see it, this is the why you should invest in digital, not because of what I'm going to show you. This is the why, right? You want to hit this, right? The solar industry doesn't have doesn't give me an ROC of 50%. Do this, and you will win. Do this, and you will grow. Do this, and you will be flying. Now I'm just going to come quickly to the drivers of the trend. It's just something that I would like to sort of get out of the way. A lot of things are important over here. You have lower overheads. This is sort of stuff that I tell my clients as well, at least the ones outside of India that I deal with. And hopefully this is what my sales team tells the clients in India. But lower overheads, lesser space, quicker payment cycles, flexibility of run sizes, no cutoffs, in case just translating that. Quicker turnaround times, higher average revenue per print, which is a number that we've got. You get more revenue printing on digital. Who knew? Again, doesn't apply to everyone, but on average. There's one bit that I did want to highlight, which is quicker payment cycles, right? The advantage of shorter runs is not just the fact that for the client. The advantage of shorter runs is that you get your money quicker, which means your payment cycles are quicker, which means your cash flow is better, right? Business is not just profit, revenue, loss, all that. It is also cash flow. So make sure that you invest in businesses where your cash flow is good and basically your cycle times are lesser, right? Shorter runs gives you way, way, way better cycle times when it comes to financial operations, okay? So keep that in mind. Some other drivers, you get a diverse clientele. You can do more things with the machine relative to a conventional press, lesser OPEX. Again, this is again moving towards cash flow. I as a businessman, and what I've been taught by my mentor who ran like a $20 billion business is a lot of the times cash flow is more important than your end EBITDA sometimes. You know, you want that cash flow to be perfect, right? Lesser consumables and lesser moving parts. You get multiple cutoffs. You don't have to pay for paper and plates. I mean, all this is covered. But this is your driver. This is the cause. This is not the effect, right? A lot of the times you guys are going to be so focused on the causes of why all this is good. All you really need to look at is this. You just get a better return when you do this, right? It cannot be simpler. The whole purpose of me doing this is because obviously I want digital to grow because that's my product and this is what I do. But it's also because I grew up in this industry. This is what I've done. This is all I've known. And I want you guys to grow. Now, I may not be right 100% of the time, but a lot of the times numbers just don't lie. Numbers are what numbers do. They might not be great in some cases, but this is the honest truth. We've not manipulated anything. This is what is happening at the moment. Will it change in 5 years? Maybe, right? The trend that you're seeing is it's going towards the digital side, but I don't know what happens, right? Trump may do something but I don't know, right? I don't know. Something may happen. But right now, these are the numbers that are as they are, right? I want you guys to understand the financial metrics of it, the application base and the way it works and the colors and the shorter runs and the features that a machine has. That's like the last 20% of the thing that you guys should be worried about, The first 80% of it is what impact does this have on my profit and loss statement and on my balance sheet? And this is the answer that I'm giving you. That is what you need to focus on, and that is what you need to do, right? Yeah, that's sort of all I have for you. I know I'm a little short. I've been quicker than I thought I would, but that's all I have. I love being a part of this industry. It's given a lot to me, and I hope I can catch up with a few of you guys. If you guys have any questions, you can come up and chat with me anytime. So thank you very much. That's about it. Thank you.
Thank you, Mr. Rishab Kohli. Can I request Mr. Anil Arora, Director, Ray and Vision India Private Limited, to please come and present a memento to Mr. Rishab Kohli.
Thank you so much. Pleasure.
Thank you for coming.
Absolutely.
And, absolutely a lovely presentation.
Thank you so much. Oh. Thank you.
We have to go.
Oh, a little bit in the middle. Thoda aur.
The photographers are the choreographers here.